All right, my name is Daryl Martin, and I want to welcome you today to this presentation. Thank you for joining me. We're going to talk about spread foundations. And we're going to go over the basics. And they may be basic, but they're actually essential that you understand exactly what they are and how they work. And I want you to understand options, not just spreads. So we're going to talk a little bit about options as well. So first thing is, what is an option? Well, if you want to buy a house, but let's say you don't have the money at the moment, but you still want to get it and you want to lock in that price. Well, you can buy an option on the house by paying the seller, let's say, a fee of $1,000 for the right to buy the house for $100,000 in the next 6 months. Now, if you don't buy the house in the next 6 months, the option expires. The seller gets to keep the $1,000. But if you exercise your right, then the seller still keeps $1,000. Okay, but they provide the house to you for $100,000, even if the house is now worth $200,000. So in this case, you paid $1,000, but you made an additional $100,000 in equity in the house instantly as soon as you bought it. Now, you could even go and you could sell that option to someone else. Let's say you decided you didn't want to buy the house, and you sell it to someone else, and you could actually, they pay you $100,000 for that option, or $101,000 for that option. You go and sell it to them and pay off the other, $100,000. So between the two, you could actually make $100,000, and they pay the original owner $100,000, and now you've made, net of $99,000. They pay you, the difference there. So, but what if the housing market drops and the house is only worth $75,000 in 6 months? Well, you can say, you know what? I don't want to exercise my right to buy this house for $100,000. Now, the seller will still keep $1,000, but you're not going to lose $25,000 in decreased value. So, I actually had this happen where I was going to buy a house, and it was on a lake, and I went to buy the house in cash. And I didn't have the cash at the moment. I didn't want to use that much cash up at the moment, and so I actually bought an option on the house. And it was actually right around $1,000, and gorgeous, area right on the lake. I'm like, I love this. The house was okay, but the location was perfect. I'm like, I can rebuild later if I want to. And well, so it happens that there was a massive fire. It burned down all the houses around the lake, and obviously I chose not to exercise my right on that option. And so instead of paying for that house, say $100,000 or $200,000. I was out $1,000 and I just walked away. So, and that's what an option contract allows you to do. And, sort of like I was talking about earlier, if you did decide to resell the option, they could buy the house for $100,000 before the option expires. So, if you don't have the money to pay $100,000, but 3 months later, let's say it's worth $125,000, you could sell it to someone else, the option itself, for $25,000, say $500. Then they would pay the option to buy it for $100,000 before the option expires, as they think maybe it's going to $200,000, or maybe they just want the place. Okay? So, there's a lot of different ways you can use options, and you can also use them on things like stocks and futures and foreign exchange. A call option, so what's called a vanilla call option, just a regular call option, gives you the right to call it away from someone else. And you buy a call option because you think the price is going to go up. So pick up the phone when someone calls you. Okay, up. So the strike price, the word strike price, gives you the right to buy it at $100,000. Okay? The expiration date is, say, 6 months from today. So that'd be your expiration date. And let's say you paid $1,000 in premium. Now, what is premium? Premium is made up of two things. The price of the option contract is made up of two things. It has intrinsic value and extrinsic value. And often people use the word premium and extrinsic value, together, and that's okay. But the total option premium is intrinsic and extrinsic value. So when the house was worth, $100,000 and you bought the right to buy it at $100,000, then the $1,000 premium you paid was purely extrinsic value, as it was only buying you time. It wasn't really buying you value, right? So, because, you weren't putting any money into the house. You were paying $1,000 and you're going to pay the full value of $100,000. Okay? Now, when you sold the option to another person for, say, $25,500 and the house went up to value, let's say, of $125,000 in that 3 months, well, you received $25,000 in intrinsic and real value because the house is actually worth $125,000. So you sold it for the contract for $25,500 for the right to buy it for $100,000. So you got $25,000 in real value, which is value that the house has, and $500 in time value, which is the remaining 3 months of the extrinsic value. It's not real value, it's time value. Okay? And a couple other things can go into that. We'll talk about that as we go through, the different trainings on spread options. But the important thing is that you understand intrinsic and extrinsic value. Intrinsic is the actual value that exists, and extrinsic is the time value. Okay? So if you get that piece down, then you're doing good. Now let's talk about some other options, or other terms that go with options. We got ATM, which is at the money. Okay, that's what it stands for. So at the money. And that's when you bought the option to buy the house at the strike price of $100,000, and the house was worth $100,000. And that's at the money, because the price you bought the option at was at the money, is right at the value of that underlying market, which in this case was the house. Okay, it was valued at the strike price, so it's at the money. At the money options are the most expensive options. They will have the most extrinsic, time value, premium, part of the premium in there. They will be the most expensive. Now, I don't mean the most expensive as money you put up. I mean most expensive as in money you're paying for time. Okay? Now, there's out of the money. So if you would have bought the option, say the right to buy the house for $100,000 when it was only worth $90,000, then the price would have been less. Let's say $200 for the call option. It would have been out of the money, as the house is not worth the price of the strike price. So this could be a good thing to do, as the option is actually cheaper for you. So instead of paying $1,000, you only pay $200. It's out of the money. If you decide to exercise it at the 6 months, then you'd only have paid $200 plus the $90,000 the house cost, for a total of $90,200 for a house that's worth maybe $100,000 if it went up. Okay, so you can save money by using out of the money options. Of course, if it doesn't go up, then you just threw away $200. But it is a way to save a cheaper value on the time value by choosing a price higher than what it's worth. Okay? In the money is when you sold the $100,000 strike option to the other option buyer 3 months later. So when the house was worth $125,000, then it was $25,000 intrinsically in the money, as the strike price of $100,000 is actually inside the actual value of $125,000. So again, the right to buy it at $100,000 when it's worth $125,000. I mean, there's $25,000 of intrinsic value in the money. Okay. Now, what about a put option? What's a put option? You've heard of call options. What's a put option? Well, a put option is basically really how you cover your risk in the real world. How do you cover risk in the real world? How do you do that? If you want to cover risk on a home or a car or life or health, it's insurance, right? So a put option is basically insurance when you buy it. Did you know you can even use put options on your investment accounts? There's different ways to do it. And some accounts don't allow options, but you can do them outside the account in different ways. But there are put options that help cover the risk, help at least reduce the risk, would be a better way to put it. Because it's insurance that you can buy for stocks, forex, and even futures. Or you can just buy it by itself. Okay? So if you have a homeowner's insurance and the house burns down, then you get reimbursed for the home burning down. If you had a put option, insurance on a stock going down, then you can get reimbursed for the stock burning down. Okay? If you buy put options on stocks, futures, or forex that you don't own, if they go down in value, you can actually make money. So you can buy insurance on things you don't even own, thinking they're going to go down. And going down isn't bad. I mean, maybe the price of oil is going down. right? So there's a lot of ways and things that things can go down. But you can insure stuff you have, and you can even just buy the insurance that put options on things you don't have. So let's say you have a house worth $100,000, and you buy insurance, a put option, to reimburse for the $100,000. So let's say it costs you $1,000 in premium for the insurance, because the policy is at the money. Okay? If the house burns down, you're out $1,000, but you get back $100,000. So you only lost the premium instead of the full value of the house. Now, if you bought an insurance policy when a house was $100,000, and you had a strike price of $90,000, for $90,000 being reimbursed to you, if the house burnt down, then that would be like having a $10,000 deductible. Okay, so buying it out of the money would be sort of like having a little deductible. So you lost the value in the home, that $10,000 that you wouldn't get back on the insurance policy. So if the house burned down to the ground, you'd get $90,000 back, but you'd be out $10,000 of deductible equity or intrinsic value. But you only pay $200 on the premium because the premium's cheaper because the put option was out of the money. So there's a deductible amount you would not be reimbursed for. So there's money you wouldn't make if you buy it further out of the money. Okay, further, and we'll talk about what out of the spread and things like that here in a little while. So now there's also things called credit spreads and debit spreads. Some people like calling them, they liken spreads to being debit spreads. If you compare a spread to a vanilla call and put on a Friday, now I'm talking about a Nadex spread. They call it a Nadex call spread. Don't know why they call it a call spread, but there really is no good reason to call it a call spread. But anyways, it's just a spread. Okay, it's a vertical spread. If you compare spreads to vanilla calls and puts, again, they're the same price. They expire on the same day, same strikes, all that stuff. Within less than 24 hours to expiration, they act like the pricing of a simple call or put from the floor to the center, and then the opposing from the center back to the cylinder floor. Okay? By the way, there's no such thing as a credit spread. As in all spreads, you are debited. Okay? And you don't get like a credit when you buy a credit spread on normal options. Okay? Vanilla options. However, the debit is referring to and the credit are referring to the premium or the extrinsic value either being on your side or against you with time. So if the premium is on your side, meaning you're making money as implied volatility drops and time passes, it's a credit spread. If you lose money, price stays the same, and IV drops, and time passes, it's a debit spread. Okay? So there's credit spreads and debit spreads. It's sort of like thinking about the credit is like if you're the insurance company and you're collecting the premium. The debit spread is if you're, the insured and you're paying the premium. So, but in reality, when you put the trade on, it's just a matter of time being for you or against you. Okay? And so don't get all caught up in credit spreads and debit spreads when people talk about it. Just understand that's what they mean. Credit, time for you. Debit, time against you. Okay? Now, Nadex has spread options. They have two kinds of spreads. They have touchback spreads and they have call spreads. And touchback spreads is a totally different video. I cover the differences between them, in my foundations training on touchback spreads. But the Nadex spread options, they have premium built in them. And touchback spreads don't have premium built in them. Okay? And there's good and bad to all of it. But let's just focus on just the Nadex call spread options to keep the training as simple as possible. So I want you to understand they are options. Okay? They have optionality that impacts the price. You have choices. Most of them will not mirror the underlying market. And again, you have options. Okay? So with that, let's go into what they are. We're going to talk about what is a Nadex spread. Why trade a Nadex spread? What's the value? We're going to talk about how to trade it, with reduced risk. We're going to talk about moneyness, optionality, movement, premium, proximity, and a lot more in our trainings that we're going to do on Nadex spreads. One thing I'll suggest that you do if you haven't done it already is hop on over to nadex.com, and under trading, they ought to have a demo account link that you can get where you can open a free demo account, which has massive value. Okay, you need to learn how to hit the buttons, watch the contracts move, make your mistakes in demo. The pricing may not be exactly the same. The feels may not be exactly the same as live. But you need to learn discipline. You need to learn how to actually just use the platform and trade it. So if you haven't done it already, hop on over to nadex.com, grab yourself a demo account, and fund a live account when you're ready. So let's talk about a capital comparison, okay? And let's say, the euro dollars trading, it doesn't really matter what the price is, but just to equalize everything, we're going to make it really simple. All right? And we're going to make the size across the board worth 125,000 units of currency. Okay? So, if you did this, you'd have to buy 100,000 ETFs. Okay? Or 125,000 spot, one future contract, one contract of future options, or you buy, 10 Nadex spreads. Okay? And, put the price on all of them, say it's at 125, 1.25, 1.2500, or 0.01 times 125,000, like for an option. Or for a Nadex spread, it'd be 1.2510. Well, the leveraged value, okay, is $125,000 on all of them. Meaning that's the kind of capital you're getting to control is 125 grand. To do this on day trading margin, you put $31,000 on a ETF, exchange traded fund, which is sort of like a stock. Okay? Or if you want to do spot FX, you put up, $3 grand. $500 if you want to trade a future on the day trading margin, if you had discounted day trading margin. $2,500 on an option. And only $250 on an Nadex spread. The leverage on the ETF would be 4 to 1. Be 50 to 1 on spot FX, 250 to 1 on the future, about 50 to 1 on the option, and 500 to 1 on the Nadex spread. So you're getting really good leverage putting up less money. That's, to control the same amount. Now, if the price went up to say 27.40, you'd make $3 grand on the ETF. You'd make $3 grand on spot Euro USD. If you had, say, a monthly expiration on the option, you'd make $463. Now, if you use the Nadex spread, you'd make $2,875. Not bad. So, what if it moved down to 1.2250? Because you make a little bit less on the spread, right, than you do on the other ones. Well, you'd lose a little over $3 grand on the ETF, a little over $3 grand on Euro dollar, a little over $3 grand on the future, $1,250 on the option, and only $250 on the spread. So you get more leverage. You got same control capital. You're making just about the same amount of money as you are on all the other ones. Putting up less capital, and you're risking less total dollars. Seems like a no-brainer. Okay? Now, the touch brackets work pretty much the same way. So those are also something you could look at. But I want to get you started right now on the spreads. And there's some other benefits to the spreads. Now, what about Nadex itself? If you don't know about Nadex, all the products have capped risk. It's a U.S. regulated exchange. You can't lose more than you put up in risk. And you still get excellent buying power. You can trade stocks, indices, you can trade future commodities and forex pairs all in the same account. All with capped risk. And these are not the same as binaries. Okay? So these are completely different contracts. And you can see some pretty cool benefits of checking them out. Now, Nadex provides spreads and binaries on the following markets. They got Euro dollar, pound dollar, Aussie dollar, dollar yen, Euro yen, pound yen, dollar franc, dollar CAD, Aussie yen, and Euro pound. They also have corn, soybeans, oil, natural gas, gold, copper, and silver. They have S&P 500, NASDAQ 100, Russell 2000, the Dow Jones. Now, this is important. They all are based on the future contract, not the index like SPX, not the ETF SPY. They have different pricing. They are priced differently. You want to be looking at the S&P E-mini futures contract, not the Qs, okay? Not IWM. So, you don't want to look at the diamonds. You want to look at the futures. Okay? So, diamonds are the ETF for the Dow. Again, they have different pricing. Look at the futures, because that's what the pricing of the spread contract is based on. They also have international indices like FTSE 250, FDAX, and the Nikkei 225, but they are delisting, I think, the Nikkei soon if they haven't already. And they have added Bitcoin spreads as well. So a couple fun changes on there for you. Expirations. All right. They have intraday contracts that last as little 2 hours. They have daily contracts that go up to 22 hours and 15 minutes. They even have weekly contracts coming out now. So, they're already in demo. They'll be up in live soon, where they'll have weekly contracts. They'll have a big, wide weekly contract. So now, the larger the time frame is, the wider it will be between the floor and the ceiling. The shorter time frame will be narrower. Okay? Now, let's talk about expiration and settlement. Okay? So, I hope that makes sense to you real quick. Just go back over that. The larger the time frame, the wider it is. The shorter the time frame, the narrower it is. I'll show you an example on the next slide. They have, all their times are quoted in Eastern time. By the way, I set my charts in Eastern time. I set my computer in Eastern time. I do not live in Eastern time. But by setting everything on my computer in Eastern time, my news feeds, my charts, everything, then everything is always on the exact same time and I don't get confused. So, major tip for you, highly suggest changing your computer to Eastern time and setting everything to Eastern time. When I walk away, I happen to gain an hour. So, it's a little benefit. I live in the central time zone. Spread, range, and width, the distance between the floor and the ceiling. So, and then number of contracts. So they'll put one in the middle, one above, one below, and now they're even on a lot of markets starting to list 5 contracts at a time. So pretty sweet. They keep adding more and more benefits. Trading hours, times when new traders can be entered and exited before settlement. And we'll talk about settlement and what it is and all that. So here is a visual aid for you. And what you're looking at, I know this seems like a whole lot of information, but what you're looking at right here is floor to ceiling, 8 hours. That big yellow area, that's it's a daily spread. It's the widest spread, often called the master spread. Okay? And then, of course, now with the weeklies, they'll have even wider spreads. But, anyway, so you got a master spread there. And that's your daily spread. And then you'll have, like, say, 8-hour contracts. Okay? And they'll be narrower. They'll be like, instead of 600 pips wide, or ticks wide, they'll be 250 ticks or pips wide. And so they'll have one that's literally established right here, and add 250 to that, and then subtract 250 from that, and then have one surrounding it, 125 above, 125 below, to where the market is when it opens. So it's 250 above where the market is when it opens, another one 250 below where the market is when it opens, and then one straddling that, 125 above and below. And then they have like 2-hour contracts. Okay? And if you go over to them, they're 100 wide. Now, this is different markets have different details, but 100 up, 100 down, 50 up, 50 down. So again, notice what I said about how they'd be wider the longer it was till expiration. Okay? So the 2 hours, 100 wide, right? These 8 hours, like 250 wide. The daily, 600 wide. So they're wider because they have more time to move. Therefore, more movement is possible during that time. All right, pretty simple. Now, what impacts the price of these contracts, these spreads? And we'll talk about how they work next. What impacts the price is where the underlying market is in comparison to the bidder offer and the floor or ceiling. Okay? So where's the S&P 500 and where's the floor and the ceiling of the spread? So like I showed you over here, you had a floor and a ceiling versus the market there on that chart. Where's the market in comparison to that? How much time is there to expiration? Just like if you get insurance, there's 6 months policy going to cost you more than a 1 month policy. 1 day is going to cost you more than 1 hour. That type of thing. And then implied volatility, which is another fancy word for expected move. When you heard IV or implied volatility, it means expected move. So such as, think of a teenager, okay, is going to have more expected volatility when they drive than someone who is in their 30s, hopefully. Right? So That person having more expected volatility is probably going to have to pay more for their insurance. A 16-year-old versus a 30-year-old. Okay? Same thing in options. More expected movement will impact the price, make it more expensive. Less expected movement, make it less expensive. More time will make it more expensive. Less time will make it less expensive. Okay? So it moves in pips and ticks. So tick and pip is the last digit. And it's another fancy word for minimum increment move. You may have heard the word cent before, right? A penny, a cent. That's the minimum move of $1. Or tick-tock, like on a clock, is the minimum move on a clock. Okay? Well, in this case, a tick is on a future contract, is the minimum increment move. Or a pip is for when you have two currencies against each other. A pip. The nice thing is, Nadex, a pip, a tick, it's all the same. Okay? So we use those terms interchangeably when we're talking about pips and ticks on spreads. All right? Now, every digit, the last digit is worth $1 a tick for each spread bought or sold. I'll show you exactly what I mean on that. What's really important is that not every contract does not move tick for tick with the market. Again, every contract does not move tick for tick with the market. So if you buy it and you think the market went up 5 points, why didn't my spread go up 5 points? Well, probably because you haven't watched the entire spread foundations course. Okay? So, if you understand it, you'll understand why they move. And we'll go into that as we go into each section of foundations. Now, Bitcoin is a little bit different. Bitcoin, unlike the other spreads, moves in $5 increments at a value of 50 cents per increment for the weekly contracts and 5 cents an increment for monthly contracts. So it's literally going to go from 5 to 10 to 15 to 20. And each time that's going to be a 50-cent move or a 5-cent move. Okay, so that's Bitcoin. So unless you're trading Bitcoin, then you don't even need to worry about that. But side note that I figured is important that you should understand, just in case you do. So let's talk about how they actually work. And let's just throw an example up of the euro dollar. And we got a floor. Remember I talked about floor, 21.20, and a ceiling of 22.20. So you got a floor to ceiling on every spread. And again, they automatically select these when it comes out. Remember, they put one, like, say, 100 pips above, 100 pips below, and one straddling the market, 50 above, 50 below. Okay? So they automatically post the spreads up. And they post the strikes and the widths and all that. The difference between them is the floor and the ceiling, hence the term spread. Okay? So, in this case, it's 100 pips wide. Now, remember, it moves in pips or ticks. A pip is the last digit quoted. So, the very last number on there. Okay? So, it may be in 1 or 0.1 or 0.01 or 0.001 or 0.0001 or 0.0001. Okay? It's the last digit quoted. And every pip or tick on every spread except for Bitcoin is worth $1. So, in this case, there's 100 pips, so it's worth $100. Okay, makes sense. Makes the spread the maximum value of the spread is $100. Okay. Now on this spread, you can't lose. Let's say you buy it, you can't lose any additional money above the ceiling, or let's say you sell it in this case. You can't lose any additional money above the ceiling, and you can't get stopped out. So you can be down on the trade, but not out. Now, you can't make any additional money below the floor, but there may be another spread you can get into or a wider spread. Don't let that hold you back, okay? So, let's say you sell it at 22.10, and the ceiling is 22.20. The difference of 22.20 to 22.10 is how much? 10 pips. Every pip is worth $1, so your max risk on the trade would be $10. All right? And if you go from the price you sold at 22.10 down to 21.20, then there's 90 pips of profit potential on the trade. Okay, so the profit potential is $90, risk is $10. All right, hopefully that makes sense to everybody. Now, if we flip it around, if you buy the spread, can't make any additional money above the ceiling, Can't lose any additional money below the floor, and you can't get stopped out. So if you buy it at 21.30, okay, and the floor is at 21.20, the difference is 21.30 minus 21.20 is 10. So 10 pips or ticks, right? And every pip being worth $1, that's a $10 risk buying it. And you can make up to $90. Okay? And again, it doesn't have to go all the way up. It doesn't have to, if it goes above it, you still make the maximum profit if it expires above that price. Okay? Now, what happens if you want to close it and you don't want to wait until expiration? Well, you can close the spread at any time before expiration. So you could get on here and literally you could decide to sell this contract, okay? It comes down and you could buy it. You could buy it and it could fly up and you could get out. Or it could fly way down against you and you'd still be able to stay in the trade and be down just your maximum risk on the trade, and it could come back up and you could sell it again. And then you could sell it again, and then it could come down and you could buy it back. Or you could hold on to it and the spread expires, it will close at the settlement price. Settlement price is based on the underlying market. Okay, they basically just take that indicative quote you may see on Nadex. They take the last 25 trades or bid offer, average of the bid offer on FX. They drop the highest quotes, the 5 highest and the 5 lowest quotes, and average the middle 15. And that just makes it fair so people can't manipulate the markets. So what does all that mean to you? It means when you buy it and it expires, the difference between where you entered and exited or entered and it expired at, if that's 1 pip, 10 pip, 15, 30 pips, that's what you made or lost, depending upon if you bought lower than you sold higher and expired higher, right? Now, one thing is you don't have to worry about any margin calls. You don't have to worry about flash crashes. You don't have to worry about whipsaws. You get lower risk on a lot of markets, and often you can put up less capital. So some pretty cool benefits. And this is a classic option I've shown a lot of times before, but I just want to remind you of it because this is what makes it worth learning how to trade these things. Okay? So this is just an old example of the pound dollar, but looking at it, let's say you're doing some analysis and you draw a trend line and you're like, okay, I'm going to enter if it, bounces off that and goes short. And I'm sick of getting stopped out, so I'm going to put my stop up here. All right? Put it above the high. We've all done that 1,000 times over. And so we sell for $56.85. We have our stop at $57.50. We risk $650 on the trade. Now this is doing that's a big stop. But let's just say you did, and if you trade long enough, you have, and put up $3,000 in margin to do the trade. And what happens? You get in, and the trade just pops down. You're all excited. Then every little, this is the most painful part in trading, right? It's the every little tick on the way against you. Your heartbeat rising each time. And this is where you have the big battle in trading, where you're like, well, should I get out? Should I move my stop? If I do get out, well, then do I get back in? Do I go long? Like if it breaks above it? Or do I get back in and go short? But then what if it goes long against me again? And you have this round and round, and you're like, well, last time I didn't get out and I got cremated. But man, the 3 times before that I didn't get out, and it finally came back in my favor because it always comes back in your favor until it doesn't, right? And then you decide, okay, I'm going to be disciplined. I'm going to follow my stop. And so you take your stop, and then you just watch painfully as it just drifts right back in your favor. And it did exactly what you said it was going to do. And you just want to pull your hair out. Okay? This is what spreads are meant to help you with if you use them correctly. Whether you use them directly or in the Ultimate Hedge, as I teach in the Ultimate Hedge course. But right here, that trade, as painful as it was, you could went in on a spread with a ceiling of 5,700 and a floor of 5,450. 250 pips of profit potential. You get in a little bit lower, same time, but a little bit lower price because there had some optionality in there, and I'll talk about that later. You sell 10 at 56.65. You have 35 points of maximum risk because your risk is from where you enter to the ceiling. Okay? So you do 10 of them. All right? To equal the same size as what we did on the FX. You're only risking $350. You only put a margin of $350. And it can go above it. You're down, but you're not out. And then what happens? Next, it goes in your favor. Expires out. You make a profit of $760. So let's compare the two, the spread versus the underlying. On the underlying, you risk $650. The spread, you risk $350. The underlying, you put up $3,000. The spread, you put up $350. You lost $650 on the underlying. You made $760 on the spread. Same trade, same chart. Okay? Obviously, spreads are worth figuring out. Now, one more thing I want you to do is if you don't have access to it yet, it's free. Go to apexinvesting.com and sign up for our spread scanner. Because it's going to make everything I'm going to teach you a lot easier. And it's going to make trading the spreads easier. Because it's going to do all the math you need to know, like the premium, the proximity, the prices, the risk, the reward. You can look at contracts on multiple expirations, multiple markets, all at the same time without having to click all around. It auto refreshes. It has stops on it, stops for entry and stops for exit. So there's a lot of really cool features and tutorials and all that stuff. So make sure you take advantage of that if you haven't already. Now, the biggest caution I want to give you is there is more to spreads than what we just talked about that you need to understand to trade them effectively. You know just enough right now to make you dangerous. Okay? You need to understand moneyness, optionality, proximity, implied volatility, premium, and speed. What drives that speed, such as time to expiration, spread width, market, and implied volatility. Okay? I'm going to explain that to you in our other foundations courses, but make sure that you don't think, oh, I got this, because you don't have it yet. Okay? You need to understand these other pieces, and I'm going to go into little bits and pieces that I haven't covered before and show you some examples I haven't shown before. And I want you to really dig in and understand these contracts. They are among my favorite contracts. They're still not my favorite contracts, period, to trade. Okay? So, again, this was Daryl Martin with apexinvesting.com. Make sure you hop on over to our website and learn more about how to trade spreads.